Hey, Bulls and Bears, we are back with another dose of economic reality. It is Friday, March 17th, 2023. Today is St. Patrick's Day, so happy St. Patrick's Day to all of those celebrating, and maybe you're wearing green, so enjoy your shamrocks, shenanigans, and the greens and all that good stuff. Maybe you're drinking green beer today. Either way, let's get into the financial economic news. As usual, a ton to get into today. A lot is happening in our world, in our economy, our financial sector, which we all use at some point or another. So let's get into the details here. And folks, let it be no secret, we are in now financial crisis 2.0. We are in it right now. This is the beginning. The reaction to this, or the jump to try to resolve this or control this, is much quicker than it was during the financial crisis in 2008. Also, remember back in 2008, the limit for FDIC backing of deposits, checking accounts, savings accounts, was $100,000. They raised it to $250,000. That's where it was up until recently, but now it's essentially unlimited. So the government is guaranteed to come in and pay off or make whole all investors, regardless if they're multi-billionaires, billionaires with a B. So this is a bailout of companies, of billionaires, of people with more than $250,000 in their accounts. And this really takes the banks off the hook in a large part, because banks have a lot of securities. They have a lot of loans on their books, which they securitize and bundle into loans. For example, a mortgage-backed security. And the government's just going to come in and buy all this debt now, all of these securities. So it really takes the banks off of the hook for the portfolio of the securities that they hold on their books. This could still take a couple different directions. I don't pretend to have a crystal ball here to know exactly how it's going to go down, but here are definitely a couple of the, I think, the obvious paths that we can take. One path would be very inflationary, where banks now know that they're backstopped, or if they're not going to survive, that they're just going to get bought out and taken over. But there's not any repercussions. There's not any legal repercussions, right? So they could really loosen the lending guidelines from here. That means a lot more subprime loans, even though subprime loans are becoming late. Actually, right now, for car loans, automobile loans, we're worse now than we were at the peak of the financial crisis as far as subprime loans being late. But now with this guaranteed backstop, what is the incentive for banks not to give out more loans, right? If they know they're going to be backstopped, if they know there's going to be this huge rescue plan, rescue program. So it could be a lot looser lending, a lot more people getting loans for more so they can keep buying vehicles that are already ridiculously priced. Maybe people can buy homes that are ridiculously priced. Maybe the guidelines will loosen there. Maybe they'll lower interest rates. We already saw the 10-year bond yield drop quite a bit. And so this is going to be the worst case scenario, the inflationary path, if we do take that. The other path is going to be deflationary. That's if banks are still concerned about not being backstopped, or about not being able to fulfill the making their depositors whole again if they fail. All right, so this could go one of two ways, and I hope it's deflationary, but I have a feeling and a fear that it could be inflationary. Now, let's be clear, this is a return to quantitative easing. We're going to have to see what happens. The markets so far have responded favorably or positively to this news of this guaranteed backstop of the financial system, of the banks. Normally, the stock market would have cratered by now. So we are headed for a very dangerous, highly inflationary environment, in my opinion. Also, it's going to be difficult. Of course, it's going to be most difficult for people that are already on fixed incomes. We know the number for people living paycheck to paycheck also is between 60 and 70%. So it's going to be something unprecedented and something that we've never seen before. And I also doubt that the Fed's going to keep raising interest rates. So it could go both ways. They could keep raising rates, the Fed funds rate, but yet somehow manage to keep mortgage rates suppressed. Because remember, the mortgage rates and the Fed funds rate don't always go hand in hand. It's more about the 10-year bond. So they could push down the bond yields while raising the Fed funds rate. That would be a really, really interesting environment to witness. But we're going to get a chance to witness some very interesting things going forward. Let's get into some more news here, some recent news I want to get caught up on with you. Now, I talked about this in my previous report about how First Republic Bank was rescued by other banks. And I talked about Bank of America and JP Morgan. It was actually 11 banks total that banded together to create this rescue of a $30 billion infusion into this failing bank, First Republic. Um, these were Chase, as I mentioned, Bank of America, also Wells Fargo, Goldman Sachs, Morgan Stanley, U.S. Bank, Truist, PNC Bank, State Street, and Bank of New York Mellon. Each deposited over $1 billion. So another kind of a head scratching thing, but the rationale behind it was that if they could save this bank, even though it was a competitor or rival, then that would stop the possible contagion or stave off the fear amongst the population. And all banks have an interest in stopping fear from spreading throughout the population. Once the population feels that the banks are not going to be backstopped, once they see one or two or three or four failures, they're likely to pull their money out of even the big, too big to fail banks. Now, so far, we've seen a flight into the too big to fail financial institutions because people feel more confident with those institutions. But I think the fear is that people would lose faith in all banking if this didn't happen. So therefore, you see this unprecedented backstopping here of this First Republic Bank from other banks. And here's a quote here: "These actions of America's largest banks reflect their confidence in the country's banking system." The banks issued this joint release here. Continues: "Together, we are deploying our financial strength and liquidity into the larger system where it is needed the most." Unquote. Also, Fed Chairman Jerome Powell and Treasury Secretary Janet Yellen, and two other regulators said in a joint statement, quote, "This show of support by a group of large banks is most welcome and demonstrates the resilience of the banking system." Unquote. So they're really, really pushing and encouraging this backstoppage of the failed banks. So it's interesting, even though banks are more leveraged now than ever, we could see less bank failures now than we did in 2008, just because of this unlimited ability to create new currency out of thin air, inject it wherever it's needed, and just backstop this entire failed banking system here. Also, without all of these actions that we've witnessed over the last week or so, we would have seen a huge, huge downturn in the economy. So many more layoffs tied to these banks would have occurred, and that would have been more dominoes falling, because the more layoffs you have, the less people spending money in the economy. So now we're going to have billionaires rescued. All the employees that work at these banks are still going to have their jobs, very likely, because the banks are going to remain operational for the most part. There are still going to be banks that'll get taken over and gobbled up, for lack of a better term, gobbled up by a larger bank. So we're going to see more consolidation, but it's going to be this concentration of market share that we're going to continue to see regardless. And it's going to be very highly inflationary, in my opinion. Also, another possibility is that lawmakers can come in with much tighter and stricter regulations on these banks. They could even take away the ability for banks to loan out money that they do not have. That would be highly deflationary. All right, so anything could happen. There could be new laws implemented. I really doubt that anyone's going to hold the banks accountable, or put the lending on a leash, so to speak, or bar the reserve system, or restrict the reserve system right now, where banks can loan out money that they don't even have. because the people that would pass that law would probably not have a job very long. They would probably, find a way to get rid of these people, if you know what I mean. So I expect inflation, but maybe something crazy will happen where new regulations are put on the banks and there could be deflation. What they would have to do is restrict these banks, stop these banks from loaning out so much money. They would need to have the money in the bank in order to loan it out. Actually, they should have a 2-to-1 ratio, rather, where the banks would have to have twice as much in deposits as they loan out. So for every million they have in deposits, they should only be able to loan out 500,000. I just think that's an example of something that would fix this. It would also deflate all of these asset bubbles. You would see falling, crashing prices for homes, for cars, anything that has to be manufactured, and anything that people borrow money for. These big types of purchases, you would see a massive crash in the prices of those assets. Food, that would be a different story because we still have a lot of problems with food. But actually, if people couldn't swipe their credit cards, which they are now, a lot of people are swiping their cards just to buy groceries. It would be more difficult for credit card companies to issue so much available credit if they had to abide by the same rules as the depository institutions, where, for example, again, if you loan out $500,000, you have to have $1 million in the bank to deposit it. So 2-to-1, you have to have twice as much in deposits as you loan out. That would fix a lot of problems. It would actually really, not completely fix, but it would really help bring a lot of people out of poverty. It would bring the cost of living down, and so many people wouldn't be living paycheck to paycheck. So that would be a solution. Will it be implemented? I highly doubt it, because the people that are that are running the show, they're making lots of money and they're living just fine. They don't really have much of an incentive to really change it if it doesn't affect them. Right, now let's stay on the topic of bank runs and bank failures. Another reason why banks are not likely to fail is because of what we've witnessed. All these other institutions that came together to rescue First Republic, the same thing. These larger institutions could come in and just buy up these other failed banks and prevent the banks from closing, so they could keep the branches open. Right now, there's actually banks that have been bought out by other banks and consolidated, but yet they still keep the same name as the original bank. Now, sometimes that doesn't happen. Look at a Washington Mutual. That bank no longer exists, but there are banks that have been bought up by other banks that kept the same name. Sometimes they'll change it to the name of the institution that bought the smaller bank, but that's going to keep the money flowing into the economy. It's going to keep people borrowing money. The pin, or I'd say the wrench in the machine, though, is going to be the U.S. consumer. The U.S. consumer is going to be the one needing the bailout next, because how much debt can you load up on with these interest rates and with this cost of living, and how long can the consumer last, right? So that's another thing that's going to need to be rescued. What type of rescue programs are we going to see for the U.S. consumer? That's yet to be seen. And, people, when they first heard me talking about these things, they said, oh, that's impossible. Bank runs, bank failures, rescue programs, bailouts, we're here. So what we've been talking about for many years now is finally here. Look what happened in 2020. We would have had about over 7 million people losing their homes if it weren't for the stoppage of the foreclosures, because so many people were out of work at that time in 2020. So another unprecedented thing that happened in 2020. More unprecedented things happening this year as far as keeping this system, keeping this financial Ponzi scheme propped up. And we just have to, know what's going on to be able to navigate this. Continue, my opinion is continue to accumulate real assets, precious metals. We know that most of the world is going to precious metals, gold and silver. A lot of people now even getting their retirement accounts moved over to precious metals accounts, where it's not just fake digits on a screen. Everybody keep stacking, and thanks for tuning in here.